Thank you all so much for joining us for the latest installment of ABNY University. The series began as a way for experts to share their industry knowledge and essential professional skills. And today we're lucky to have a wonderful panel with us to share their expertise. Adrienne A. Harris, Norm Champ, and Ratesh Dhir. Adrienne Harris is a professor of the practice and Gates Foundation Senior Research Fellow with the Center for Finance, Law, and Policy at the University of Michigan. She's an investor and advisor for early stage startups. Previously, Adrienne served as special counsel to President Obama for economic policy at the National Economic Council. Norm Champ is the former director of the Division of Investment Management at the U.S. Securities and Exchange Commission, or SEC, and author of Mastering Money, a personal finance guide for all working Americans. Ratesh Jain is the head of business development and B2B at Earnin, a leading fintech company in Palo Alto that helps employees from over 50,000 companies get paid as they work to help pay bills, avoid debt, and save for the future. The panelists today will discuss an important and timely topic: how to prepare for personal financial recovery post-COVID-19. They will discuss economic impact of COVID-19 on young professionals and advise on ways to better manage personal finances. We will start with a moderated question and answer, and based on the questions submitted in advance by the attendees, and then transition to a live Q&A. Please feel free to post questions throughout the webinar in the Q&A function, and we will address them at the end. As always, we encourage you to spread the ABNY message through social media and tag us at ABetterNY. Without further ado, I will ask the speakers to introduce themselves. We'll start with Adrienne, and then Norm, and end with Ratesh. Adrienne, take it away.
Great, thanks so much, Sarah, and thanks to the team at ABNY for having me. I think you summed it up pretty well. So I teach grad school at the University of Michigan. Prior to that, had started my own fintech company in San Francisco that is now still growing and scaling, which is great. But I spent a lot of time advising fintech companies, especially in the financial health space. I sit on the board of the Financial Health Network, which is all about providing good financial health for Americans. And spent some time in the Obama administration as a special assistant to the president, managing the financial services portfolio there. But started my career as a young professional in New York as a lawyer, and lived there longer than I've lived anywhere else. And it really is my spirit city.
Hey, Norm Champ. As Sarah mentioned, I used to be the director of the Division of Investment Management at the U.S. Securities and Exchange Commission, which is the division of the SEC that regulates basically the investment activity of funds in the United States. So think mutual funds and private funds. Before that, I was in private asset management at a hedge fund manager, partner in that business. Before that, I was in the private practice of law. It sounds like, we have some lawyers. Since leaving the SEC, I've been back in private practice, helping primarily private fund sponsors with regulatory issues, leveraging off the time at the SEC. I teach investment management law at Harvard Law School every other year. As Sarah mentioned, I just recently published a book called Mastering Money that I'm going to recommend to all these young professionals out there. I was once a young professional in New York. I'm not anymore. I am in New York, but I'm not young anymore. But it really was an attempt to have kind of a back to basics personal finance book. So it's not, Robert Kiyosaki telling you how to borrow millions to buy real estate or any of those things. It's really about kind of three main things: trying to, cut expenses and keep our cost of living down, increase income and job development, those kinds of things, getting to a positive net worth, and then investing very conservatively for the future. Because if you do that over the long term, particularly for young professionals in our audience now, all the statistics show that if you invest early, I have the example of the book, if you invest from 20 to 40 and stop, you're still ahead of the person who starts at 30 and keeps going until retirement. So, your young professional years are huge years for maximizing your 401k, trying to put money aside, because the long-term benefits of compounding are just amazing. So anyway, I'll keep going and let Ritesh introduce himself.
Perfect. Thanks, Norm. Thanks everybody for joining. My name's Ritesh. I head business development at Earnin. As Sarah had mentioned, we're fintech. We help people living, well, essentially anybody really, but there's a lot of folks who are obviously living paycheck to paycheck, access their pay as they work, help them to manage their money better, help them to avoid overdrafts, save for the future. I live in Silicon Valley. I have been in startups for a number of years. I love the innovation around it in a number of areas. And I'm very, very excited about fintech and what we're doing today. Prior to this, I had spent time in the financial markets at the Chicago Mercantile Exchange and Chicago Board of Trade. I've traded futures, options, Forex, equities, you name it. So I've been very, very immersed in that world and am a personal finance junkie. So I'm not a guru. I'm not a financial advisor anyway, but I do have very strong opinions, and my kids and friends will tell you, will corroborate that.
Great. Well, thank you all so much again for joining us. We really feel lucky to have such a panel of experts with us today. And, you know, I'd like to jump right in and talk about the current state of affairs in New York City. So this past June 2020, our statewide unemployment rate increased, our city unemployment rate increased. Do you think this trend will continue? Have you seen any hopeful signs in the past couple of months that it will reverse? We'd love to hear your thoughts on that.
Well, let's see, maybe as the New York resident, I'll go first. So, you know, I think, you know, this is obviously a challenging time for New York City, and I think challenging time for young professionals starting out in New York City. I think, you know, the unemployment rate in New York City is running more than 2 times higher than the national unemployment rate of 8.4%. So we are being disproportionately impacted, I would say, partly because the virus hit New York so early, and then we had such long, you know, extended lockdowns, and, you know, public policymakers currently, you know, have still been very slow to open New York back up. And so New York's being hit, you know, disproportionately. The other part of it is that, unfortunately, state and local government, you know, state and city government, it's, you know, it's always distressing, right? City government ran a huge deficit in 2019 when things were great, right? And the economy was booming, tax revenues were booming, and they ran a deficit. That doesn't leave much room for a rainy day. And, you know, now the city is billions and billions of dollars short of the revenue, you know, that it would need to meet its current obligations. And it's essentially unable to cut much expense because of union contracts and other things. So unfortunately, I think you know, the short to medium term for the city is very tough. I think, you know, maybe for young professionals starting out, I think there are, as always, when there's trouble, there's opportunities. You know, rents in Manhattan have plunged, greatest percentage drop since they've been keeping track. So, you know, I think as you think about your own personal situation, if you have a job in New York and you think that is going to continue, it is a time where there is definitely an opportunity to save on housing costs, which for all of us who've lived in New York, I've lived in New York for 30 years, saving on housing costs is a great thing, particularly when you're young and starting out. So that is one bright spot, is that you can get much more affordable housing. I don't know if anyone else wants to chime in on the city.
So I'll just, I mean, speak generally, right? I mean, I think, Norm, you're absolutely right. New York has been hit very hard just because it was early in the pandemic, right? And just because of the structure of what is New York City. It is a dense place, and, you know, highly dependent on all the industries that have been impacted so incredibly by COVID. But the trends nationwide are bad. People are hurting all over. We've seen, you know, a bit of a uptick in employment over the summer, but I think it remains to be seen what will happen as we get into the winter months and we get potentially a resurgence in the virus, as people are predicting. So I think, you know, to Norm's point, I think people would be very wise to continue thinking strategically about their expenses, taking advantage of lower housing costs in the city where they can, because it's hard to predict how this is all going to play out over the next year, 18 months. And so preparation will be key. But I think, even though there's been some signs of improvement in the economy generally and in unemployment generally, I think everybody expects that this is going to be sort of a longer haul.
Yeah, I think I echo a lot of the comments that my other panelists have made. I think what I can share from what we're seeing, some positive data points. So at Earnin, since we help people get paid as they work, we have a pretty good idea of when people are actually working. And so when I think about how things were just in March, we had seen a 70% drop in members, and that makes total sense, right? Because people were not working, so therefore they couldn't actually use our service. And that kind of started to stabilize more around April and May. But what I can share is that right now I'd say we're about 70% of where we were pre-COVID. And so whilst there is still a long way to go, that's definitely a big jump from where we were. And also the trend is in the right direction. So that does make us feel hopeful. But certainly there are going to be, we're in no illusion, there's going to be a number of challenges still ahead.
Oh, I think, Sarah, you're muted.
Sorry about that. I just wanted to jump off something that a lot of you mentioned, which was the housing cost in New York City. So, I'm experiencing this myself as a young professional living in Manhattan and seeing the prices change. So do you think that that will be affected by, the transition to working from home? Many workers are thinking about leaving New York City for larger, maybe more affordable housing. On the flip side of that, we are seeing the housing prices go down and rent going way down in New York City. What do you think companies can do to retain talent in New York City? And what do you think young professionals from a financial standpoint should do in terms of saving money and making sure that they're making smart financial decisions?
I'm happy to kick this one off. I think, a couple of important things to note. This sort of trend of people leaving big, expensive, mostly coastal cities for places with lower cost of living had actually started before COVID, right? COVID actually clearly accelerated it because people had the flexibility to work from home. But this phenomenon that we've seen, right? People, I think, have been evaluating the cost of big cities, whether it's because of the cost of housing, right, taxes and the like, and thinking to themselves, I could spend the same, $2,000 and have a mansion in pick your other state or city that's not California, New York, right, Massachusetts. That said, I do think, right, this work from home, I mean, New York will always be New York. I'm sure everybody read the Jerry Seinfeld op-ed, right? New York will always be New York. It will always have that sizzle, that pizzazz, that sort of special sauce. But I think as far as talent goes, right, what we've now seen with the ability to work from home is it is really a democratization of talent, right? Companies will be able to find talent and put talent to work from all over the place, which is a good thing, right? They won't necessarily be limited to the talent in their geographic area. They'll be able to attract talent from all over. But then cities will have to reevaluate, right, how they keep people there. And to Norm's earlier point, right, keep the tax rolls moving and making sure that the budgets work. And I think it's going to come down to policy things like making sure there is affordable housing, right, or subsidized housing. Employers offering other benefits that make it attractive for people to be nearby, right, and thinking creatively about what those benefit structures look like. To off, things that you talk about young professionals, right? Student debt is a huge issue. My students all the time, we talk about money, we talk about savings, we talk about investing, and they're like, how could I save? How could I invest? Like, I've got all this student debt. But you're seeing more and more companies offer things like assistance with debt repayment, right? Other perks that offset the expense of being in big cities. And I think it's really going to be incumbent upon companies to think creatively about how they do that.
Yeah, I think that's I agree with what Adrienne said. I think certainly living in Silicon Valley, San Francisco, we have the same housing challenges as right, as New York. And so I think this is one of those opportunities for governments at local level and state level to actually step in and, as you mentioned, like certainly provide more affordable housing for a lot of folks, and encourage people to be able to stay. And I think also, like, whether it's partly subsidizing that and also working with private landlords. I think, you know, looking at a number of private landlords right now, and I'm sure in New York they would be having a similar thinking pattern. You know, if they could be working hand in hand with some of the employers, I think they would be very open to engaging with them on helping subsidize rent in return for more longevity, right? But certainly until things stabilize, I think they're going to be a lot more amenable than they've ever been.
Yeah, and I think a couple interesting, you know, points in your question. I do think that the biggest, you know, I'll go out on a limb here. I'll predict that the biggest change here is going to be that work from home and working remotely is something that I think particularly young professionals were very interested in. And, you know, they've obviously come up the whole way with the laptop or the iPad and, you know, the phone. And I think we're very interested in kind of that aspect of work. I would say that so far what I'm seeing in private companies is this 6 months, right? What do they say? 2 months to make a habit. So we're now 6 months into, you know, Zoom world. And so what I'm seeing is private companies, I think, much more accepting of the remote work environment. And while I agree with you that New York goes back to being New York, you know, for sure, I do think there's going to be more flexibility by private companies to allow people to work remotely. Adrienne's earlier point about finding talent anywhere and, you know, being able to leverage that. And so now the only problem with that is that's not so great for New York City, right? Because that would indicate further people not living there and not wanting to pay the cost of living there, right? So that could continue to hurt the tax base. But I do think you're going to see private employers. You mentioned, what can companies do? I think private employers are going to look closely at this and say, wow, maybe I don't need 5 floors in a Midtown New York office building, which is costing me $100 a square foot. And maybe I could have 1 or 2 floors, some hoteling offices, you know, some conference rooms, and people could work from home more. I do think it's going to accelerate that trend. And, you know, but again, not so great for the city if a lot of people are living outside it and working from home. You mentioned about, you know, finances and what should people be thinking about. One thing that I've been trying to urge people is like, look, we're all sitting at home, so we don't have commute time anymore. Think about expenses. You know, the first side of this equation is, what are you spending money on? Most of us are not very intentional about what we're spending money on. So I'll just give you a simple one. Average American has 9 apps on their phone that are giving them recurring charges on their credit card. Most Americans use about 2 or 3 of those 9 apps, right? So most of us use Spotify or Netflix or whatever it is, but you've got a bunch of others and generally you're not using them. So very simple exercise, take a look at your credit card and get rid of the apps that you're not, you know, that you don't need to be charged automatically every month. Those are small dollars, but it's an example of looking at other things as well. You know, are there other expenses out there that maybe you don't need or, you know, are not as important? We are in a consumer society. We're all bombarded with messages to spend. When I open Amazon, I'm sure I see things that are designed for me to buy, and I'm sure each person sees different things that are designed for them to buy. So it's tough, but I would say maybe try to take advantage of the time and think about spending, because that's the first thing you have to get under control is the outgo side. Because if you spend more than you make, you're going to end up usually with credit card debt, which is so high interest and so tough on finances. So I'd say short answer, while people are stuck at home, maybe take a look at that credit card statement and look at some other of the expenses and see if there's anything that you can cut out.
Well, and no, I know we're going to talk more about financial advice later, but Norm, I mean, it's such an important point because you say like these charges, they're small charges, but A, every little bit makes a difference. And B, there is something to this habit of digging into your finances, right? And starting with small changes. like getting rid of that $9.99 subscription fee that brings you no usefulness, right? And then it becomes easier to tackle the bigger financial challenges, right? Paying more than your minimum credit card payment every month, things like that. So like starting with those small steps, I find just makes all the work of financial organization and financial health just a little bit easier, a little bit less stressful to start to undertake if you can start with small steps.
Yeah, that makes a lot of sense. And I think a lot of our questions sort of focus on that aspect. We've had a lot of questions about people that are able to save money on the pandemic. You know, they're not eating out as much, they're not spending on entertainment. But besides putting in a savings account, they're not really sure how to make that useful. So what do you think are some good options for young professionals to make their money work a little bit harder? And how would you suggest organizing these options?
I'd love to start, but I know, Norm, you're gonna.
No, go ahead.
Are you okay? All right, I'll give the short version, and then again, I'm not a personal finance guru or anything like that, but I think and I think really like a lot of stuff that Norm has said is right and kind of similar way that I think about things. I think like certainly you need to have an emergency fund, right? So if I've saved money right now, I want to make sure I have at least 3 months, if not 6 months of savings. We're in a pandemic, right? We're in a somewhat precarious labor market. You may lose your job, you may get sick, you may need to go and take care of a loved one. You know, what I found throughout my life so far is having that emergency fund really gives you choices. And I've been able to do things that I otherwise normally would not have been able to do, right? And so build that cushion for yourself, 3 to 6 months. After that, you really want to make sure that you're paying off anything where you have expensive debt. And so I'll just throw out an arbitrary number here, anything over 6%. If you're paying for anything, an interest rate like that, you should be paying it off aggressively. Anything that you save isn't really, if you invest, isn't going to make any difference if you're paying, you know, over that amount. And then the third one is then thinking about getting into your investing. And that could be through a 401k where there's significant tax advantages. Otherwise, you know, you're going invest in an index fund, a low cost index fund. Do not pay money managers to manage your money. And again, you know, speaking as somebody who's traded professionally for a number of years, you know, I do not, that's exactly what I do. Set it, forget it, focus on your career. You guys are the leaders of the future. That's where you should be spending most of your time.
Yeah, I think, and I'll let Adrienne go too, but I think, so totally agree with Ritesh on emergency fund. This experience has shown all of us how critical it is, right? And, you know, as you look at the jobless claims each week, I mean, think about the fact we're jobless claims currently running in the 800,000s. The absolute peak of jobless claims in the 2008, 2009 crisis was 600,000. So we're still running 250,000 above that record. So the emergency fund, critical, couldn't agree more. Totally agree on high debt, high interest debt. And I know people, the student debt and all the different things, you know, Sarah, that you mentioned, try to get down any credit card debt. That's usually double digit in interest. So try to pay down any high interest debt. When you mentioned about making your money work harder, I'll take that one and let Adrienne take the rest. I think that one thing I just, you know, want to say, particularly to young people, is there are so many things available to you to make your money work hard for you that are very simple and very cheap, right? They don't cost very much. And one thing I saw at the SEC that surprised me so much was how much just garden variety fraud there is that takes advantage of investors. And we mostly called it affinity fraud because people are often scared about managing their own finances. And there's someone in their community group, church group, you know, somewhere that they trust, and they sort of go to that person to manage their money. And often, unfortunately, that turns out to be, you know, a fraud. Bernie Madoff preyed on people primarily of the Jewish faith. You know, this is a standard pattern for these fraudsters, is to go into a group, an affinity group. So I would ask, you know, I'd urge everyone to take your own control of this. of investing. So let's say you get there, you get your expenses down, you get the debt down, you've got some money in the emergency fund. Keep that in a place you can get at it. That could be low interest. It can be in a savings account or something. You're going to need that, so you don't want to have that tied up. After that, you can go simple. If you're employed and there's a 401k at your job, if you have an individual retirement account because you're not, at an employer, that is a tax deferred way to earn a ton of return. And you can do very simple asset allocation. Take the number 100 and subtract your age, and that should be your stocks. So if you're 20, you should be 80% stocks, 20% bonds, something like that. You can then express that asset allocation through mutual funds, and the cost of mutual funds in this country has dropped to literally, 10, 20 basis points. So very cheap way to access the markets, heavily regulated by the federal government. So people have lost money in mutual funds, but no one's ever stolen any money out of mutual funds. So just really think of a very simple asset allocation and stick with it and start slowly. I get all the time, should I buy this? Should I buy gold or commodities? Or, start simple and work from there.
Yeah, I'll echo everything that's been said, right? The emergency fund, paying down the debt, starting with the credit cards, because those tend to be the most expensive, and on down the waterfall, right? All of that is right. But I do want to double click on this idea of starting with simple stuff, right? This is just basic blocking and tackling. And I think what often happens with young professionals is one of two things. One, because you can't do everything all at once, you do nothing. And you don't want to do that, right? You just want to start with the simplest things you can, lay out a plan for yourself. Or you think, wow, but the mutual fund, like the returns, maybe they're not great, or it's so long before I'll see, right, this growth. It's fine, right? You're not like out there trying to seek alpha and think about like what venture capitalists are making, right? It's just basic blocking and tackling. It's not sexy. It shouldn't be, but those are the kind of things that will pay off for you over time.
I think that's really helpful. And as someone who has personally felt overwhelmed at times by my own financial stuff, I definitely can relate to that. I'd like to hear a little bit more from you guys about how technology and particularly fintech or financial technology can help young professionals navigate their financial recovery. There's so many different things out there that really make it easier. And I know that you guys are the experts on it. So I'd love to hear about that.
Ritesh, I think we'll start with you on that.
I'll kick off on that one. So I think first of all, it's a very exciting time, right? So innovation in fintech is unprecedented. 10 years ago, we didn't have anything close to what we have today. And before that, not at all. And so I think today there are a huge number of tools to help you to understand your money, manage your money, save, invest, budget, build a credit score, maintain your credit scores, and so forth. And then there's a lot of really trusted resources as well. So, if I was advising somebody and somebody said to me today, hey, what should I do? Where should I start? I would look at, there's certain third-party blogs which are kind of independent, like NerdWallet, which are really great, right? So, because how do you make sense of all of this stuff? Which app should I use, and so forth? And so you can start at a place like NerdWallet, find what you want, what credit card should I have if you need to have one, or what savings account should you have, and so forth. And they'll do a very kind of like honest review of what it's of what it can do for you, and the pros and the cons, and so forth. So it's a great place to start. All of the apps are public, so look at the reviews, right? It's not like, again, how somebody could say to you, hey, you should use us, we're the best. Well, let's see what other people actually think about it. You can't really hide behind that. And so those are really great things to do. A lot of the other great part is a lot of these services are free or very cheap or have no fees. When I think about what we did at Earnin with helping people get paid as they work, we actually don't have any fees at all. People, hey, leave a tip, pay us whatever you think is fair. And if that number is zero, that number is zero. I mean, that's like pretty crazy. And the number of people I actually speak to, when I explain our business model, they are afraid for the future of my employment. and then I'd say to them, we've actually been around for over 6 years. And so again, it's turning the models on their head. We have tools within our app, which we have a product called Balance Shield, where we help people avoid overdraft fees. So if your bank balance falls below a certain amount, we'll send you an alert, and it'll tell you that your bank balance is below a certain amount and you can top it up. We have a service where we will automatically top it up for you. We have a financial planning tool in there as well, which shows you when your bills are due, so that you can plan around them. So if you're planning on making a purchase or something and you have a big bill coming up, it's easy for you to be able to plan around that. And a newer service that we launched is a savings product called Tip Yourself, and there you're able to create custom tip jars for yourself, right? So if you want to save for a rainy day fund, you want to pay off a credit card debt, you want to pay off a loan, you want to save for a vacation, it's made it a lot easier. And I think that's where there is a big difference between how things were before. Like when I was growing up, right, it was enormous amount of discipline that you would have to have in order to create a budget. Let's face it, who creates a budget, right? Who wants to create a budget? Nobody wakes up saying, oh yeah, I want to do that today, except me. But that's a separate story.
Maybe me too.
But I know that's not how it is. When I talk to people, and most people, I realize that's not how it is. When I look at what tools are available today, I'm like, that's incredible, because you can just input something, connect your bank account, and in 2 minutes, it's already done for you. So you get a clear picture of where things are at. And so I think, those things combined make it much easier for you to do.
Yeah, I would echo that. I mean, part of the promise of fintech has been that it makes personal finance, institutional finance too, but personal finance more accessible, more convenient, cheaper. It has the ability to bring your data together in a way that helps you make better financial decisions and action on it, right? Immediately from your phone, right? As you're sitting in bed or in front of the TV or whatever it is, that convenience factor does really make it much easier for people to make better financial decisions, or to put in place these automatic mechanisms, right? To pull money from your checking account every month to a savings account at a different institution that's out of sight, so that you won't spend it. There are apps that help you prioritize your debt, right? So instead of, we know that credit card debt is the most expensive generally of debt, right? But if you don't want to go digging through all your agreements to figure out which debt is the most expensive, there are apps that will help you prioritize that. There are sort of endless choices. And to Ritesh's point, all you need to do really is go on. I mean, you can go in Google basically any fintech app, right, and get reviews, or you go in, and you say Acorns versus Stash, and there will be endless number of websites that give you the comparison of those two, right, and many others. So it just takes a little bit of work on your part to do it. I will say, part of what has happened with the evolution of fintech and what those of us in the industry often call embedded finance, right? The fact that you can pay for things in app, it does make it easier for you to spend, right, more quickly. If you are in Instagram, the fact that you can purchase through Instagram without what behavioral economists call the pain of paying, right? You don't have to physically remove cash from your wallet or purse. You don't have to take out a credit card, right? But you can just press. It does make it easier to spend. And so some of this technology, right, you have to catch yourself so that you don't get sort of caught up in the flow of it. But largely, I mean, as Ritesh said, there's just so many tools out there to help you. And the beauty of that is you can find tools that work for your situation, that work for your brain and the way you think about money. I mean, there really just are endless options. And I think that's a great thing for consumers.
And, very little to add. I couldn't agree more. I think just a couple things. So in Mastering Money, I have links to every possible good site I could find. Of course, it's a year old, or coming up on a year old. So there's 10 more sites, and, it's definitely the way to look on the web. The other thing that I would just also say is there's lots of other materials. So they're the apps themselves, they can do all these things for you, but then there's tons of other materials on the web that, sort of that help you think about behavior, right? Because I actually think of this as two pieces, right? Part of this is our own behaviors. And then part of it is the stuff we're talking about, like getting to the point where we can put money to work, right? Sarah, back to your point of making your money work. You got to have the first part, the behavioral part, because if again, we're in a consumer society, every message bombarded at us is to spend. Even our government, wants us to spend, right? So one of the classics I always cite, 50 years ago, you could walk into the US Post Office and you could have a savings account. Now, observing where the post office is now, I would not recommend that being brought back, but just think about the fact that 50 years ago, the government was helping you save. Don't hear too many messages from the government these days about saving, right? It's about spending in a consumer society. So we're all bombarded with that. And to Adrienne's point, spending has become easier. So also, I would say, look at some of the behavioral material on the web and think about yourself. And I love your point about things that work for you. Think about your behaviors, you know, like it's sometimes very simple, right? Maybe we're having a bad day, so then we hop on and buy some stuff, right? You know, how can we kind of get out of that and move to it? Because you've got to get the behaviors under control in order to take advantage of all this tech. But the fintech is phenomenal, and you can access so many investments and tools, and the low cost points that we've been talking about, right? As you know, Ritesh saying is free or just very minimal fees on most of these services, right? They're predicated just like the Spotify's and Netflix, right? They're predicated on a small fee just over and over again. And that's the deal with these sites. And to be able to access the kind of investments you can access with low cost is tremendous. I also think, you know, I have some great friends who are financial advisors, but just think of the old model. There's a financial advisor and they take you out to dinner or golfing or whatever and recommend some securities, right? I mean, as Ritesh said, we've moved so far from that. It's like, you know, it's like light years, right? And so much exciting stuff available for everyone.
Great. And one point that I'd like to touch on that you guys mentioned, and I'd sort of like to expand on it, is how these apps have really democratized the process. And now any young professional can really have at their disposal all these different resources to help them manage their finances. So as we think about the long-term economic recovery of New York City, you know, we're really trying to think about how we can recover in a fair and equitable way. So what role does technology play in creating a more inclusive economy and making sure that our recovery is equitable?
So I'm happy to start here. I mean, I think, you know, to the extent that, just to pick up on the financial advisor example, right? To the extent that those kind of services used to be limited to those of a certain income or wealth class, right? And you had to go wine and dine and do the golf thing, right? And now much of that, right? A lot of that value that you get, not all of it, right? But a lot of it has been democratized, appified, made mobile, right? So you can access that sort of advice, those sort of services much more easily, and that's good for the majority of people, right? It democratizes that access. I will say, not to be sort of a Debbie Downer, right? But there are limits to what democratizing technology can do, because of course, most fintech is premised on, you know, you already have a bank account or a credit card that gets linked to the app. And so while that may be wonderful for most of the audience here today, there's a big swath of the population that is still unbanked, underbanked, and for whom that technology does not particularly help, right? Or that we still struggle in this country, sadly, with a digital divide. And so if you don't have consistent, reliable access to broadband, right, there are limits to what technology can do. Or frankly, you just are not making a lot of money, right? If you're making $30,000, $40,000, there is no app that is going to, right, like make you a rich person or, right, help democratize lots of facets of your life. But for this audience, I mean, the tech really does, by making things more accessible, by making things cheaper, our ability to access information online and break things down into a way that's understandable. I mean, it's all helped us make great strides. And as far as the equitable recovery, I mean, I think a lot of that is going to be driven by policymakers. We talked a lot about affordable housing. I think that's a huge one, because for most people, housing is their biggest expense, even if you don't live in New York City, right? If you live somewhere in the middle of the country, housing is likely your biggest expense. So a lot of those are going to be policy choices. And the last thing I'll say on this too is just, you know, on a very micro level, not that this will make the economy or the recovery more equal, but it does help if we all, right, everybody's stressed. It's a pandemic. People are thinking about losing their jobs, right, income. This crisis is unique in that we are all experiencing the stress of the pandemic in the confines of our own home, right? In a decidedly like non-communal way. And so I think it has made it harder for people to exercise empathy for their neighbors, for their fellow citizens, right? And like, because we're not with each other and hearing each other's stories in person the way we did even with the last financial crisis in 2008 and 2009. So on a very micro level, I always urge people, like, you know, approach your neighbors, your friends, strangers, people in your community with empathy. And when you find ways to help, you should definitely take advantage of that as best you can.
Yeah, I'll just add, I think those are great points. I think I'll just add that, you know, obviously in this recovery, we want to make sure that the essential workers are, you know, not forgotten, right? Like it's really funny, like when you look at actually what's actually happened and who we actually looked up to and who were the true heroes. You know, you're thinking about your emergency service workers, your grocery clerks, right? Your nurses and so forth, just to name a few. And so I think it's really important, and, you know, certainly at a policy level, to ensure that those people are taken care of and not forgotten, right? Without them, like things would have been 100 times worse. And then just on the fintech side, I think one thing that has really helped to really help with inclusion and so forth is like the fact that so much of fintech is mobile based, right? So having a smartphone, which is like 80% of people in the US have a smartphone. Over 90% of millennials have a smartphone, unsurprisingly. But the point is that it's really made it much, much easier for people across the board to access financial technology services, right? That otherwise they wouldn't be able to have. So if you didn't have a laptop at home, right, what would you do? And so those things have really, really helped. And yeah, and there are definitely some gaps, as Adrienne pointed out. And I know that in the fintech world, you know, there's you know, new things popping up every day that are trying to address that. I think what I think is that wherever there's a gap in that market, it's going to be filled in the coming years. And I know that a lot of that stuff is already being worked on. You know, when I think about what we do at Earnin, it's also been very exciting because for us, if we're helping give you access to your pay as you work, it doesn't matter if you make $50,000 or if you make $20,000. We don't care what your skin color is. We don't care what your gender is. We don't care what your job title is. It makes no difference. If you think about how that would have been if you had gone inside a financial institution, right? All kinds of biases come in. And so from that perspective, I think financial technology really is helping to democratize and will continue to do so.
So I have little to add there, although I do want to applaud Adrienne for the approaching others with empathy. I think very important in these very difficult times, and you know, think of what other people are going through, because obviously people's situations, you know, are very difficult now. I guess I'll just use one specific example to think about, which is, you know, in my book, I have a chapter called The Mortgage Trap. And I think it's, you know, there's a lot of messages in the United States that a path to wealth is through owning a home. And I would urge, and I think this is tied to fintech, I would urge everyone out there to use the resources to really think carefully about that proposition. So if you talk to the folks who bought homes prior to the 2008 global financial crisis with 3% down and, you know, 97% financed, when they were foreclosed on in 2009 and 10, and I tell many of their stories in the book, those folks are not going to tell you that those homes were a path to wealth. One terrible public policy decision in the United States was soon after the crisis, the minimum down payment for federally guaranteed mortgages was changed to 20%. Within another year or two, it was dropped back down to 3% with supposed enhanced guardrails. Why? Housing is an easy lever for government policymakers to pull. We see low interest rates, guaranteed mortgages. In the rest of the world, there are no 30-year mortgages, right? If you live in Europe, you have a 15-year mortgage. But because we guarantee mortgages, you have these very long-term mortgages. I'm not saying buying a house is not a path to wealth. It can be, but it's an investment decision like any other. And I would urge you is if, someone says, oh, you should buy, not rent, or, buy throwaway rent. Well, when you buy and you have a big mortgage, you're renting that money from a bank or other finance source. So, I've got I could go on about this for hours, but just, I would just be, and this is for everyone, this is across the whole spectrum I think that there's this idea of trying to get people to buy homes as a path to wealth. Again, it can be, but it's an investment decision just like any other. And I would urge care and taking advantage of all the resources out there to really analyze whether it makes sense. For instance, if you think you might have to move for a job, you think that might be in the next 5 years, generally you shouldn't buy a house. In fact, there's some studies to suggest that our sort of promoting of home ownership has decreased geographic mobility within the country for people. And geographic mobility often can be a great thing. If there's more jobs somewhere else, move and get one, right? But if you're stuck with a big mortgage and payments, you may not be able to move for that job. And Ritesh mentioned earlier, sort of that freedom to maybe think about that. So I guess I would use this specific example of think carefully about the decision to buy a house or an apartment as part of your overall plan.
I think that's really helpful. And, people throw out advice kind of all the time and just without knowledge behind it. So it's always helpful to hear experts on it. And I'd like to circle back. I know we spoke a little bit about some tips, but I wanted to revisit that and ask if there are some tips for young professionals to manage their personal finances now that can help them survive this economic crisis. If there are any additional tips that you guys have for the audience.
And so I'll go, I think all the things that we mentioned in the earlier segment, right, are just the foundational steps that everybody should be taking. The emergency fund, paying down the expensive debt, right? Then thinking about maxing out your 401k if you have one, or your IRA. And I do think this start with small steps. Some of it is just expense tracking, and Ritesh and I, we were sort of joking about, those of us who are super nerdy and like to think about budgeting. But I would urge people again to, do what works for you. Don't get so wrapped around the axle of what is the right way to do this, right? So I am nerdy enough that I think about my personal finances all the time and really enjoy doing it. I don't like, for instance, line by line budgets, which say things like you can only spend $10 a month on Starbucks, right? Because the tracking in that would be overwhelming for me. What I did do is create a budget and say, okay, you can afford X number of dollars of discretionary spending each month, right? So apart from your bills that are regular and planned, you have this and your savings and what goes into investments, right? I treated those as fixed expenses, right? And then I had a number that was left over that I said, okay, this is my discretionary budget. And I opened a separate checking account at a different institution, and I have that amount of money sent. I actually do it every week. So it's like smaller amounts of money and it doesn't look like a whole big pot all at once. So every week I do 1/4 of my monthly discretionary budget to a special checking account. And I know if it's not a bill, if it's not something that's going into savings, if it's not investing, I've got to use this debit card, right, for my latte, for my new handbag, whatever it is, right? And when that money is gone, it's gone, right? And if there's something left over at the end of the week, then I put it in savings or investment or something else, right? Super nerdy, but it's worked very well for me. It took me a little bit of time to come up with that system. So don't be afraid to try things and come up with a system that works for you, right? It was just enough detail, but not so much detail and tracking. So I knew I could stick with that habit because I was just like, you know what? When you go to buy the handbag, it's the purple debit card. Like this is the one you use for handbags and lattes and whatever else, right? But it did take me some time to come up with that system. So I urge people just to experiment a little bit until they find stuff that works for them.
I think I'd add that a couple of things. One is, and I'm sure in Norm's book he would have a lot more detail around this, so go do that. And then in terms of reading about stuff in like on NerdWallet or other blogs, I think like for myself, what I tended to do was kind of flip it a little bit and say, okay, this is what I need to invest because I'm a savings junkie. So it's like, if I've taken care of my savings piece and my investment piece, then the rest of it is kind of, easier for me to manage. You still need to know which pots they need to go into, but I've taken care of the bigger issues and kind of which make me feel comfortable and make me feel secure, right? Because it's a very personal decision. And so once you've done that, then it makes it a little easier. And again, just the fact that so much, there's a lot of things like this that automatically do it for you today. I think another point that Adrienne made is really important is not to get bogged down, right? Like you can get into analysis paralysis. I'm sure you're all really smart analytical types like me. And, I suffered from that tremendously because I was like, oh, what if I optimize this by 1%? And then you do the math and I pull out, EF on my spreadsheet and I'm like, oh, they could be like that when I'm 42. And like, it's nonsense, right? Like it prevents you from moving forward. So, kind of get to like an area and just execute on it, like get it done. Don't worry about over optimizing it. I think one other thing I'd suggest is just slightly separately from just pure financial, what you can do financially is really like take a look at yourself and invest in yourself, right? Like be the best that you can be in your job. And so if I think about your employers right now, they know they're in a, we're in a challenging financial area. Everybody knows that the resources that we have to do better. We have to do more with less. And so, when I think about people like in our organization, for example, or other companies, you're really always looking for who are the future leaders in your organization. And to my mind, the people who are going to be top of my mind are those who are going to be really stepping up right now, because now we're in pain. And if I'm like, oh, that person's been able to do this, that person's been able to do that, and really build on their responsibility, when things improve and I'm now looking to expand my team, who am I going to think of, right? So put yourself in that position. Go to your bosses, ask them, what can I do? What can I do to help more? How can I help move the needle? What are our particular challenges? And just really do that. And I think that will lead to more career success for you, which ultimately will mean also, a better path for financially.
So I would say this is a perfect example of the behaviors that I was talking, right? It is behavioral, right? And you're hearing, the different ways that we all got here. Why are we here talking about personal finance? Mostly because it's something we're very interested in, right? And, that we all love, you can probably tell that, this is kind of a passion for all of us, and yet different paths, right? So for me, certainly like the no debt, has been one of my just really, there's good debt and bad debt, right? So if you have secured debt, like a mortgage, although with a big down payment, but if you have secured debt, it's less risky. Credit card debt and those other kinds of debt are worse. And so I totally agree with Ritesh on the prioritization of those. But I'd also kind of make a broader point as you just think about moving ahead and you're young in your careers is debt. Ben Franklin said, value of assets go up and down, debt stays constant. And so I personally have focused always on debt, really getting to a debt-free balance sheet. And Ritesh mentioned freedom, right? That if you're not in debt, the flexibility you have to pursue other avenues, things that are happening, and let's go back to the work sphere. Someone says, hey, we need someone to go and help start the, Dallas, Texas office of the firm or something, right? If you're tied down with a lot of debt or a lot of mortgage or different things, that may be very difficult for you. That opportunity might go to someone else. And again, you may not want to take that, you have to evaluate the opportunities. But I would say in our society now, the federal government's in terrible debt. Most people are in terrible debt. If you can get yourself into, a less of a debt position, you get so much more flexibility if you have equity in your life as opposed to debt. And so I guess my one thing would be really focus on getting debt down. The freedom that comes from that can help you take advantage of so many other opportunities. And again, maybe geographic mobility, whatever it is, you heard it on the different behavioral things that we're each talking about, and mine would certainly be debt reduction.
I'll just add one other thing if I can, Sarah. I think, there is a little bit of a taboo in the US about talking about money. And so we all sort of sit and suffer in silence about our debt levels or how much we've saved or haven't saved or what we invest in and what we don't, right? There are some exceptions, usually at the very top of the income spectrum, where people talk about it quite a bit. But for like normal folks, right, there is just this taboo about talking about money. You know, there are also differences along gender lines and along race lines about those cultural taboos. But I think to Norm's point, right, like there are very few Americans that are in good financial shape, right? Most of us have a lot of debt or little savings, right? There's lots of statistics out there about the financial health or lack thereof of the majority of Americans. People should not be afraid to talk about it. Don't feel like it's just you. Don't feel like you have to find the answers by yourself. It doesn't mean you take the advice of just any old schmo you come across, right? But like, talk to your friends, talk to your family, talk to your mentors, because I think you'll find that you're not alone, and you'll come up with some useful advice, tips, behaviors that will be helpful to you.
Thank you so much. And I really think that young professionals can really benefit from all that advice, and especially from, the sentiment that all three of you shared, that we're all different people and we all have to approach it differently. What works for me may not work for you. And I think that's really valuable and important. I just, I'm watching the time. We only have 2 minutes left. So I wanted to quickly ask if you have any final words of advice that you'd like to impart. I know we also have some questions coming in now about student loan, income-based repayment, and purchasing a home. But really, if there's anything you want to sort of impart on the audience while we have you.
I'll just say, I'll go back to intentionality. I think what you're hearing from the three of us is be intentional about your finances, just like you are about your career and your personal life and other things. And if you take a few intentional steps, it can make a huge difference.
Yeah, similar. I'd say, the fact that you're here and listening to this says a lot about your intentionality, right? And that you want to get things moving in the right direction or continue moving in the right direction. So don't be afraid to talk about it. Take those small steps, find what works for you, and it'll all be okay.
And I'll just say, as Norm said, intentionality really matters when you think about what it is that you want to spend on. Like, really ask yourself, do I really need this? Take control of your life.
Well, I think that's a perfect place to end. And I want to thank you guys again so much for taking the time to join us today. This advice and your time was truly invaluable. And we really appreciate you, sharing your wisdom with the ABNY audience. So thank you again so much, and have a great day.